Greetings from Bermuda, and thank you very much for having me. I love talking about this topic, and let's go. What I'm going to go through today with you is what we call risks in the real world, and I will sprinkle in along the way some risks that really aren't really real world risks, so it can get some context. Of course, we'll start with performance, as we always do. Just as a reminder before we really get going, the Global Balanced Fund is designed to produce a long-term moderate risk exposure for you as clients, and we have several levers and tools that we can use to make that happen, as you can see here. These are just a couple of quotes that really typify what it means to be a contrarian investor or intrinsic value investor. And I think if you remember these quotes as we go on, you will see the appropriateness. 2 years ago, we talked about the things that would make us look smart and stupid over the following 2 years. That was at an extreme environment, as we'll see in the next slide. So you might sense some sarcasm here as you read through these. We really didn't need much to go right from that point for performance to do well. So talking about momentum shares getting less, stop getting more expensive, or cyclical shares getting less hated, you can pick up a bit of sarcasm there, hopefully. And going back, you can see what this time 2 years ago looked like. It was the worst point of performance over the history of the fund. And fortunately, so far, it's been going in the right direction since then. The current market environment, anything but boring. Let's first talk about bonds. We've referred for quite a while to bonds as reward-free risk, and until this time last year, we looked like idiots for saying so, as the 40-year bond market just continued to roll on. This period we're looking at now with these red bars, that is complained about by most, are quoted as, this is the bond market, bear market, and it's an unusual event and one not to be repeated. However, we look at the 2 bars prior as being extremely unusual because before that we were complaining about seeing zero yields for government bonds. At its peak, though, in 2020, almost 20% of all bonds in the world had negative yields, including a big chunk of high yield debt. So this is junk debt, where the rating agencies think that there's a risk you don't get paid back, where you're actually paying them for the privilege of lending them money. It absolutely made no sense. So seeing the bond market underperform now just feels like a little bit of correction from a long, long run. This is a reward-free risk described. As we've discussed, the more bond yields dropped, the higher the duration of those bonds became. And duration is their level of risk. So basically, duration works like if you have 9 years of duration and you have a 1% move in interest rates, you have a 9% capital loss or gain. Now, when yields are at 0 or near 0, the likelihood that they're going to go to -1 or -2 is very low. So really talking about in the context of if yields go up, you lose money. And here's an example of somebody, say, buying a 10-year U.S. Treasury 8, 9 months ago. You would have received 1.25% interest for the risk of taking on 9 years of duration. The impact of that 9 years of duration, when the bond yield went up nearly 2%, is an 18% capital loss. So for taking on that 18% capital loss, you received a whopping 1.25% of income. That's reward-free risk. And that's what we're seeing now. And the probability that that continues, are we done? Is 3% the peak in the US 10-year? This would say, don't even think about it. This is the Fed's reaction to current inflation. And you can see on the right-hand side, we've never had a bigger gap between the Fed's recognition of inflation and the actual inflation level. Not surprising, since the Fed denied inflation existed for a year and a half, that they're getting a late start. What's also interesting here is many poke at the 1970s and Arthur Burns, the Fed chairman at the time, as the Fed caused the Fed and the Fed chairman and Arthur Burns caused the stagflation, inflation, by not matching their Fed policy with the current inflation levels. You can see here they did a really good job relative to what's going on now. So what are people going to say in 5, 7, 10 years about Bernanke and the current Fed setup? Now, in bond land, it's not like Vegas. What happens in bond land doesn't stay in bond land. Bond yields have a massive impact on growth stocks in particular. And you can see here that kind of correlation. And if you look at this and say, this is a fairly short-term chart. If you look at this and say, wow, we've had a huge retracement, how much worse can it get? One, if you just get back to a one-year real yield, you're talking about a 35-40% drop in the NASDAQ relative to the broader market. But 1% real yield isn't where it stops typically. You can have a 2, 3, 4% real yield. So just imagine what that would do to your growth stocks. Speaking of growth stocks, we had one of the worst days ever in the NASDAQ in January, one of the worst weeks, ever in the NASDAQ. And it was followed by the very typical and understandable buy the dip type commentary. You've seen that buy the dip commentary drop a little bit, but it's still there. So we decided to look and see, well, how does that terrible week compare with all the other terrible weeks? And what kind of blew us away was that 11 of the 20 worst weeks in the NASDAQ came in 2000 and 2001. Now, having been an active investor since 1993, especially at a deep value contrarian shop, I knew well the environment that fed up to this. And this period that followed 2000, 2001 felt wonderful to us, as we had been pummeled by what you do. Valuation doesn't matter. I graduated from Wharton Business School in 1995, and all my peers went off to the growth shops, and they kind of made fun of me for the first 5 years, telling me that valuation didn't really matter. And then that's about a couple of years later, they were asking me if I wanted to buy their Porsche. So not really a joke if you were invested back then. It was a very difficult time for investors, but the deep value or contrarian investor shined. So looking back at that period again, putting that in the context of opportunity and risk, this period in 97, 98, 99 was absolutely awful for a contrarian approach or intrinsic value approach. Growth just ripped and ripped and ripped. And this was just an extreme level that we never thought we'd see again. We had people quitting the industry because they were so far behind the popular benchmarks. We never thought we would see that again, I'll reiterate. And then we had a great period of a run of value, and then we had transition back to a growthier market. You can see how we thought that would never be hit again. We hit that and then blew right through it into 2020, and COVID helped put the icing on the cake. Since then, we've had a bit of a retracement, but the opportunity level, the valuation gradient between growth and value, is still way higher than it was at the peak in 2000. So we've got quite a long way to go if you think about the opportunity that's sitting in a contrarian fund versus a benchmark. Now, this is what we really want to talk about: risks in the real world. And we've got 4 to bring to you: defense, energy transition, food, and energy. First, defense. I went to the U.S. Naval Academy in 1984 to fight communism. Lo and behold, by the time I graduated, the Berlin Wall fell. So for the rest of my time in the Navy, we saw decreases in defense budgets, as you would naturally expect, and that's continued until very recently. It would appear that the Crimea invasion or takeover by Russia has a little bit of a fire under the European names, who are typically the worst in drawing down their defense spending and rallying around the peace dividend, what they called it. Now the reality is, and it will be increasingly clear, there was no peace dividend for China and Russia. The guys who have run those countries have seen this as an opportunity to catch up and get ahead. And I think the Western world, or the free world, or whatever we're going to wind up calling it, sees this. Our theory is that you're going to go from 25, 30 years of what appeared to be secularly lower spending on defense to, it could be 10, 20 years of secular increase in defense. And these companies can go back to being the blue chip growth stocks that they were in the 60s, 70s, and 80s. Why such a heavy concentration of European names? We started buying these a year ago when Europe decided they were going to roll out a thing called social taxonomy, which was designed to starve capital from companies and industries that weren't producing social good or were in fact producing social ill. At the top of their list in their minds were the defense contractors. We looked at that and said, this makes absolutely no sense. It cannot last. And the stocks had sold off 40, 50, 60% in anticipation of getting put on this really bad list and having their company become a lot more difficult to manage and finance. These are excellent companies, and they're making excellent products that help defend freedom. So there's a schism now in the ESG world as to whether defense are very strong ESG stocks or very weak ESG stocks. But I think with what you're seeing in Ukraine and what you're seeing China do, that they will eventually flip to where they should be, because there would be no ESG without proper defense. As a test, I'd love to see somebody go and try and protest at CNOOC or Rosneft's headquarters. I'm not sure it would go well if you chained yourself to those doors. They're still cheap, so they're almost all the names we bought have doubled since purchase, and they're still cheap because the outlook was so poor, and you've had such a change in direction and in their prospects that after 30 years of poor, the analysts can't keep up and are anchored to those poor times. I mean, these are the analysts who said, I'm willing to do defense for 3 or 4 years, and then I want to do something cool like internet. They didn't really want to be there to begin with, and they're anchored on a very poor environment. Again, our theory is that the environment is getting better now, and it's going to continue to get better. So these multiples are low, but they're probably still too high for what's really going to happen. The food shortage, this is making a lot of press, but we have been concerned about the coming food shortage for 3, 4, 5 years. But let's just first look at the price increases. The first thing I want to disavow of is that this is not Putin's food price increase. You can see that this started happening a long time ago, and the seeds of this were sown 3, 4, 5, 6 years before that. I'll talk more about that in a second. So it's everything from your cooking fuel to your commodity, ag commodities. So when did this start? In our minds, as long-term holders of Bayer, one of the biggest agricultural, chemical, and genetically modified seed companies in the world, this started with the anti-GMO movement, which really gained steam 10, 8 years ago and caused entire continents like Europe to outlaw GMO seeds. Why do you have GMO seeds? You have GMO seeds so you can use less agricultural chemicals, less fertilizer, and you can increase your yield per acre. Right now, what does everyone talk about? Increasing yield per acre, because the acreage is dropping and we don't want the rainforest burned down. These companies, like Bayer, increase the yield. There's one more thing coming. So what those food price changes tell you what's been happening. Fertilizers telling you what's going to happen. So fertilizer prices are way up. And why are they way up? They're way up in large part because natural gas prices are way up. Natural gas prices are way up because they've been considered an evil carbon producing fuel. So the more you persecute natural gas, the higher the price of fertilizer goes. Here's the price of fertilizer. And you have farms all over South Africa, all over any bread belt, anywhere, wondering how much they can plant and of what, significantly based on how much fertilizer they're going to be able to get and how much it's going to cost them. So again, it's about maximizing the yield for the acreage we have. So the solutions providers for this real risk are the companies that produce agricultural chemicals, fertilizers, and seeds that can maximize yield. Bayer and New Farm are two of the biggest agricultural chemical companies in the world. They're also two of the biggest seed producers. And interestingly, with New Farm, if you went back to that that vegetable oil chart, we need a lot more. We need a lot more oil seeds planted. They are the leader in canola oil seeds. So both available at very cheap prices still, despite the fact that they are increasingly being called on to solve this problem. Now, what is a Brazilian bank doing on here? Brazil, the country, needs to also step up. They need to produce more agricultural commodities to make up for what's missing from the Ukraine and Russia. But also, as you saw, this is something that preceded Ukraine and Russia. We weren't producing enough food before then, and now it's just really obvious. But Brazil needs to produce more food. They need to increase their yields, and if they do so, the country is going to become more wealthy. Inflation's going to drop. How do you invest in a country that's improving? You can either buy the bonds or you can buy the banks. Right now we're buying the banks. We are looking at the bonds. The energy transition. So this reminds me of the 1970s. There's huge parallels between the 1970s and now all over the place. The one I'm going to talk to you about here is how do you increase energy efficiency? So back in the 70s, when I was a kid in school, we were dragged to go meet the neighbor that had the handmade windmill or the geothermal heating facility that he dug out himself. None of these things ever worked. They cost lots of money. They looked cool. They made a lot of noise, and they never made any kind of sense from a return on investment standpoint. So what Jimmy Carter did in the end, after failing on all these sexy things, they actually did what you should have done in the beginning. Figure out what produces the highest return on investment from an energy efficiency standpoint. And what the U.S. did was they incented via subsidies people adding insulation to their houses and changing from incandescent light bulbs to compact fluorescent light bulbs. Those nasty things that we're finally getting rid of. What's happening now? So everyone wants to talk about windmills, everyone wants to talk about solar panels and lithium batteries that would destroy the earth if you made enough of them to be any effective in any way. And where the governments are now transitioning to is what Jimmy Carter figured out. And the EU did a study recently that said the highest return on investment thing you can do to lower the cost of your facility or your home is to switch from CFL lights to LED lights. History repeats itself. Now, we just so happen to own Signify, the old Philips lighting, the most boring company in the world. They dominate in the market for LED lighting. They make all kinds of LED lighting. And while Europe is starting to come around, the European Green Deal has subsidies for LED lighting, and Biden is going to follow closely behind. Signify also does other things. Indoor farming is becoming very popular. If you don't want ag chemicals and you don't want GMO seeds, you have to farm indoors, keep all the critters out. If you farm indoors, you need Signify's lights. They dominate that space. Also, in the pandemic, we all noticed those blue, purpley lights that were really important in getting rid of germs. but you didn't want to look directly at them because they didn't do well with your eyes. Signifies the largest producer of those lights. Now, clearly a beneficiary of a properly run energy transition. We were able to buy this at a 13% free cash flow yield a year ago. It's still at a 13% free cash flow yield. This stock has not gone anywhere, despite the fact that its outlook has got tremendously better from its prior experience, and a very high return on equity. This is a good business. It's consolidated, and we're picking it up at a triple-digit free cash flow multiple. There are lots of names like this. Here's a list of names that basically we're buying as contrarians when we observe the energy transition that people want to have happen, and then we compare that to physics and science. And there's a saying that physics or science doesn't care about your hopes and dreams. It cares about facts. And the facts are that what's been done thus far in the energy transition has been rather disastrous. And we need to completely change what we're doing when we move to ESG 2.0. And when we do, and you see it one by one, these companies get picked up as ESG friendly and they get completely revalued. Signify, it will happen. Drax, it's happened already. So we filled the portfolio with names that are doing a good job at performing an energy transition, but aren't getting any credit for it. Now, the energy crisis. This is the first dysfunction that we saw with ESG really getting rolled out. ESG 1.0, as I refer to it, just attacked the energy companies. Didn't collaborate with them, didn't even talk to them. Any ideas they had were bad ones. But one of the original ideas was from BP. They said it again and again and again. The world wants more energy and less carbon. We can do that. But because they were the evil energy companies, nobody paid any heed. Where are we now? The world wants more energy and wants less carbon. The ESG world needs to work with the energy companies to find a proper way, a practical way to affect an energy transition. We believe that's going to happen. We've moved this around over time. We started out, the original positions were BP and Shell, and those companies were fairly heavy oil oriented. They themselves have become more gas and LNG, and the portfolio itself, we've moved more towards gas and LNG. And then more recently, as they've been completely ignored and the industry continues to try not to reinvest in production, we've invested in the services companies like Schlumberger, Borr Drilling, Valaris, Huntington, Helix. The stocks that just haven't moved at all. But we all know we need to produce more fossil fuels in order to affect this transition, or not to freeze to death and be able to drive our cars in the meantime. These companies need to be employed to increase production. So it will come around eventually. Favorite name in the space right now is Kinder Morgan. It seems like a stock that is just absolutely designed for the environment we're moving into. They dominate the transport of natural gas around North America, and they have growth. So the U.S. is becoming a net exporter of energy after for years being an importer, and in a 5-6 year period we're kind of in stasis. If you're a pipeline company, you don't care which direction the stuff goes in. You only care the volume that's going through it. And a lot of Kinder Morgan's pipes have changed direction from an import-oriented direction to an export-oriented direction. They don't care. This LNG export is likely going to double in the next 5 years. So we have nice growth prospects for companies like Kinder Morgan that sit there and produce a 6% dividend yield, well covered with a 9% free cash flow yield. And those yields are fairly secure with things like take-or-pay contracts. It's a really solid legal contracts with counterparties that are rock solid, investment grade rated. So this is a very secure 6% yield with prospects for growth. And we like to refer to things like this as better than bonds, because compare this to a 10-year treasury that is not inflation protected, yielding 3%. You'll buy this all day long. Shell, we've talked about Shell year over year over year. I think the first time we talked about Shell was 2016. But to see how much better Shell has become compared to 2014, the last time we had peak commodity prices. Free cash flow of $25 billion at $100 oil. Now they're producing $43 billion in free cash on $80 oil. The end of 2022, the average is probably going to be something like 110, 120. And you can just imagine how much free cash flow they're going to produce then. If you just annualize Q1's free cash flow level, the company can buy back all the stock and all the bonds in 4 years. So this is a crazily priced blue chip company at this point. Are energy prices going to go down? The cure for high oil prices is high oil prices. The cure for high oil prices, because capital expenditure goes up to meet those high oil prices. We're not seeing that now. This is a bizarre situation. This is not normal capitalism going on here. What it is people reacting to their ESG pledges that they were forced to make. We're not going to invest in new oil and gas production. So as long as this exists, the price of oil cannot come down. We need Schlumberger to make a lot more money in order for oil prices to go down. So not a great outlook if you're looking at filling up your tank. These represent almost 35% of the portfolio now if we updated this, and just 6% of the 60/40 index, the benchmark. And you can see here the benchmark used to have much higher levels in this space, and it will again, we believe. These are future growth companies, and we know how markets and indexes love growth stocks. What to expect? We are running a deep value portfolio if you look at the discount to market, and we think that bodes well for future performance. We'd love to own growth stocks. We keep an eye on them, but none of them become cheap enough. And the ones that we have looked at, like Palantir, the company isn't what they say they are. It's not nearly as good and solid as they say they are. So we're avoiding things like that. What should you look for in performance to see whether we're going to do well or poorly? These are the things that will make us look smart. And these are the things that will make us look stupid. The big one here being a big deflation comeback, or world going under global synchronized recession or depression. That would be very bad for the global balance at this point. Thank you very much.